education. And so sometimes we don't know what we don't know. I'm glad you're joining us. Thank you. And we're gonna teach you things in this class that you've probably never heard or never put together. So again, thank you for being on. We're excited to have you. I think we're just going to get started. So asset protection. Our company's name is Protect Wealth. We're an education company. We train people to shield their assets, to reduce their taxes, and to build wealth. What we're going to try to do in this webinar is cover four very, very complicated subjects. We're going to talk about asset protection. Asset protection, I'm not sure if you know, but less than 1% of the nation's attorneys specialize in asset protection. It's actually, according to the American Bar Association, 0.6% of the nation's attorneys claim asset protection as a specialty, and some of them are doing some weird, funky things that we think might be a little overkill for a lot of students. And almost 50 times that number is the number of personal injury attorneys out there coming after assets. And so it's a specialty of law that they rarely, if ever, even touch in law school. And so we're going to hit that. We're going to hit it head on. We're also going to talk about estate planning. And there's some tricks that attorneys do that they don't really tell you about in creating wills, in not funding revocable living trusts. And we're going to hit those things head on, because if we don't begin with the end in mind and create an estate plan as we're going along, maybe we've failed in our attempt to be good stewards of our wealth. We're going to talk about income tax reduction. If those two first subjects weren't complicated enough, we're going to take the tax code and we're going to try to hit that head on and give you some very good, real, practical strategies that you can use in your daily life to reduce your income taxes. And then we're also going to talk wealth creation. Now, why are we talking these things? You'll notice that all of them are defensive strategies. We're not going to so much hit how to make money. You'll notice if you were watching the last Super Bowl, there's something that was really important to me to notice. They took one of the best quarterbacks in the nation who couldn't score a single touchdown. Why? Because of really, really good defense. The old adage that offense wins games, but defense wins championships, that was very true in the last Super Bowl. And so what we're going to do, or we're really going to be focusing, at least on this webinar today, we're going to be talking on defensive strategies that you can do to protect assets, reduce taxes, build wealth in a safe environment. So that's kind of what we're looking to do. Again, my name is Don Pendleton. I'm not a CPA, I'm not an attorney, but I've written 5 textbooks for attorneys and with attorneys. And attorneys are really, really good at what they do. And we're glad that they're here, but sometimes they're not real good at explaining things. Where we've run an asset protection hotline and explained to tens of thousands of people these practical strategies, we've become pretty good at explaining things. That's what we're going to do. We're going to be technically correct, but not everything that we talk about is going to necessarily apply to you during this webinar. We've taught the longest running asset protection class in the nation. It's called the 3-Day Asset Protection and Wealth Creation Summit. We've been teaching this since '99 and trained thousands and thousands and thousands of business owners, real estate investors, medical professionals, people that are maybe at a high risk for lawsuits, or have businesses to protect and want to reduce their taxes, or just want to create a good estate plan. This is really what we do. The theme of our class is a lifetime to accumulate, 3 days to protect. And so that's what we've done. And when we teach, we're bringing some of the very best asset protection attorneys, best tax strategists, best the best experts on what creates millionaire and what creates wealth anywhere in the nation. And I'm frankly honored to be in the presence of some of these people. And we'll go through and kind of introduce them to you later. We've also for years taught or sold an asset protection kit long before a lot of popular companies have been selling legal forms. Back in the 60s and 70s and 80s, 𝗧𝗵𝗲, the father of asset protection, began selling asset protection forms, how to create your own limited partnership. LLCs weren't done then, but how to do your own trust, how to do your own corporation. Some of these things are easy to fill out forms. And usually when I'm teaching a seminar, I'll ask the students, how many of you have filled out a corporation yourself without the use of an attorney? And I'll say probably 25 to 30% of the people have done that. How many of you have set up your own LLC? And you'll find that once you've done that and gone through the process, it's not all that difficult. Creating your own trusts, a lot of people, I've never done that. Oh wait, an IRA is a trust. A 401k is a trust. An attorney created the form, you put your name where the name went, with the date where the date went. If it said notarize here, you notarized or witnessed. And sometimes those forms are not that complicated once you understand the parameters and what they're asking for. And that has been the crux of most of our asset protection questions, is helping people strategize which entities to use and how to fill out the forms. That's really what we've spent most of our time doing. As I mentioned, not everything that we're going to talk about today will apply to you and your situation. That's one of the reasons we're going to invite you to an advanced class where we give you a chance to sit down with professionals and talk about your situation. But not everything. I can't give legal advice. I can't say everyone in America needs a C Corp or a trust. We can simply teach good, practical, general strategies, and then get with an attorney and let's find out a way to, or a professional in your area, and let's get you some really good personal advice. You'll find that at our classes. If I were to summarize what I consider to be the biggest financial threats to a person's estate, I consider it like a tornado. Tornadoes, I live out in Utah. We don't have tornadoes here, at least not very often. But what I do know about tornadoes is that they can be very selective, but when they hit, they're almost always devastating. So here are what I consider to be the 4 financial tornadoes. We'll go through those individually. Income taxes, there's so much about income taxes. But income taxes and capital gains are a very different type of different type of tornado than a lawsuit that come down and bangs you on the head one day. Income taxes and capital gains slowly suck the lifeblood out of your estate. And when you get ready to retire, you wonder why you didn't have enough money, because you were paying too much in taxes along the way, or you weren't trading and buying within tax-free environments. We can spend a lot of time on that, and we will at the 3-day Asset Protection Summit. But I'm going to kind of give you an overview. If I were teaching a large class, and you were sitting in the audience, I would say, where do you want to spend your time? And we would go any direction you wanted to go. But in this, I'm going to give you a brief overview of each one of those and give you kind of an idea of what we teach. So let's talk income taxes. There's a couple things you need to, before we get into specific strategies, there are some basic fundamental foundational concepts that we need to understand. Number one is that there are toll roads and there are free roads built all the way through the tax system. I used to, years ago, live in the little state of New Jersey, and they promised us back in the late 70s, if we voted in this toll road, then we wouldn't have to pay property taxes anymore. All the people traveling from Pennsylvania into New York City would be paying our property taxes, and we could, as locals, just kind of get a map and figure out how to get there. Now that didn't quite work out the way that they had promised, but But that was the promise. And what we found is the police officers didn't care which road we took, whether we took the toll road or the free road. It didn't matter as long as we obeyed the laws on the road. The income tax system is built exactly the same way. There are so many free roads they don't tell you about, and they don't put any big blinking neon signs on the free roads, only on the toll roads. And so we'll talk about some of those free roads, but know that there's nothing illegal about taking a freeway. Just obey the laws on the road and follow the tax code, and you're fine. But there's so many free roads. We're going to teach you some of those. Okay. Another foundational, basic principle is that there are two sets of income tax rules. I used to think, one for the rich, one for the poor. No, it doesn't work that way. It's for those who have a business and those who don't. Let me summarize in a very basic, and some of you, this would be way too basic, but it's foundational. So let's build on this. If you receive money personally, let's say $100,000, and you're a W-2 employee, there's $100,000. The very first thing that you would pay would be your taxes. Let's say you're in a 27% tax bracket. We can say that state and federal, whatever it is, just stick with me on a big view. That gives you $76,000 to spend. If your expenses this year were $70,000, that gives you a whopping $6,200 to save for retirement. Whoop-de-doo. And that's really hard to build wealth or create a lot of wealth with $6,200 a year. Now, there's a different set of tax code, and that is for if you had a business. Let's say I've got the business. Here's the different set of rules. For businesses, they take the gross income, your $100,000. We deduct the expenses from that. So now, on the $30,000, that's what we're taxed on. You notice we're not being taxed on the gross income of $100,000 because businesses allow you to deduct your legitimate expenses from that. And now I'm going to be taxed. Not on the 100, only on the 30. Let's say I'm in a lower tax bracket now, and as a general rule, that gives me a whole bunch more money to save for retirement or to build wealth. Let's summarize this real quick. If I don't have a business, I'm going to earn it, pay taxes, and then I get to spend whatever is left over. If I do have a business, I get to earn it, spend it, and then pay taxes. Well, I'm not real brilliant at the tax game, but I really like the left side of the screen a whole bunch better than the right side of the screen. I'm also smart enough to know that I can't call everything in life a business deduction, but our goal, and keep this in mind, please, our goal throughout whenever we're talking taxes is to move as much from the left side of the screen over to the right side of the screen as we possibly can, and I'll give you some examples. In fact, here's a really good one right here. If we had a business, almost any business, whether it's sole proprietorship, whether it's an S Corp, a C Corp, an LLC, a partnership, almost any time you're self-employed, you can now deduct your insurance premiums. And you'd be surprised at the number of people that don't know that. I'm paying for health insurance, but I didn't know I could do this. Let's say I'm a full-time employee, and I still have a business off the side. You're self-employed, so according to the IRS, I can deduct my insurance premiums. That's good. But if I had a C corporation somewhere in my mix, then that allows me, according to the IRS Section 105, now I can deduct anything medically related. That includes deductibles and co-payments and herbs and supplements and mileage to and from the doctor and the dentist, and it includes vision and chiropractic and special foods if they're prescribed. That includes over-the-counter medicines if they're prescribed, herbs and supplements if they're prescribed. All of a sudden, it opens up a world of things that now what we do as our family, me and all of my dependents can add up all of our expenses, put them all together, and invoice the corporation for this. Now, I can't discriminate between this and all my other employees. I get that, but for me, it's only my wife and I have the corporation. Therefore, there is no discrimination. We're the only employees of the corporation. And according to the IRS code, we get to deduct 100% of our family's medical expenses. We don't pay for it out of the corporation. We pay for it personally, invoice the corporation, and every year we simply, the corporation pays the expenses. It reduces the amount of tax that the corporation is going to pay, writes me a check, I put it in my pocket, it's tax-free money because it's reimbursement. It's an expense to the corporation, tax-free to me because it's a reimbursement. Hope some of you are using that. Now, again, the requirement is you have to have a C corporation or an LLC taxed as a C corporation, and we have to have the proper language somewhere in our minutes, meetings, resolutions, bylaws, somewhere in the corporate documents that allow for Section 105 medical reimbursement plans. Now, some of you, it doesn't make sense maybe to have a C corporation, and maybe what we could do is instead have a health savings account. I'm an employee, but I have a health savings account, and I can't deduct everything, but I can deduct a whole bunch of things. But let's say I'm living healthy and I don't have a lot of health expenses or medical expenses. What the industry is not telling you is that you could take these accounts, keep putting money in up to the maximum amount, and use that and self-direct those and use this account as it continues to grow. Yes, it's set aside for medical expenses someday, but in the future, right now, I could self-direct this and use it to purchase real estate. I could self-direct it, use it to buy stocks and bonds and mutual funds. It could partner on a real estate deal. I can self-direct these health savings accounts, and nobody's really telling the general public this, but wealth can be created inside of that if you're good at investing a lot better than maybe the 1 or 2% that they might give you in interest. Because somebody is making money on your money, and if it's not you, then you might be missing the boat. Mileage logs. When we have a business, now anything that is business related, I'm traveling to and from, there's your standard mileage rates for 2001, 56 cents a mile, and you'd be amazed at how fast that grows up. My wife and I, we're really good at keeping mileage logs. And every year we just keep our little mileage log, and you'd be amazed at 8,000, 10,000 one year, 12,000 one year, 15,000 one year. We take out of the corporation, we put in our pocket, it's tax-free, it's an expense to the company. Again, tax-free to us because it's a reimbursement. We're going to drive anyway, but now we keep track of mileage. Now, if you're not keeping a good mileage log, it's only 56 cents a mile. And I just don't want to take the hassle to do it. Do something. Take a little stack of $1 bills, set it on the console next time you go driving for business. Every 2 miles, take $1 bill off the top and throw it out the window. And after about $3, you're going to cure yourself, and you're going to go down to Staples or Office Max or wherever and buy a mileage log, because that's about what it costs to buy a mileage log. Now, if you're too darn cheap for that, get a free app on your cell phone, and it's free. And GPS it, and every time you get in the car, is this for business or personal? And it tracks it automatically. It adds it up at the end of the year. I'm not going to suggest one, but there's some really good ones out there. Keep track of your mileage. You'd be amazed at how fast that grows. Sometimes, again, 56 cents every time on every mile, that's such a little piddly thing. Sometimes the way that we win the battle with the IRS is nickel and diming them to death and keeping track of all the smaller expenses. Again, it adds up. Cell phones, if we have a business, according to the IRS, now not in the black area of the law, but in the IRS revenue rulings that they come out with, and they say, here's how the court interprets what the code is. In 2011, the court ruled that a business can provide a cell phone for an employee. If a business requires a cell phone, and frankly, I don't know many businesses in America that wouldn't require you to have a cell phone, and it's now considered a non-taxable fringe benefit, and you don't have to keep records. Now, that's not what my accountant's been telling me all these years. He says, you have to keep records, and if 36% is for business, then you can only deduct. No. According to the way the court interprets this, I don't have to keep records. If my business requires a cell phone, I deduct the cell phone, I deduct the monthly expense. You see, we're writing this off because it's used for business, and mine is legitimately used for business. Now I take that same court fee, that revenue ruling, and I apply that in most cases to internet. If your business requires you to have internet, then according to everything I've read, you can write that off as well. Some of you are not taking advantage of home office deductions. Home office deductions are a big deal. Let's say 15% of my home is used exclusively for business. This section right here, here's my desk, here's my computer, here's my chair, and this I use exclusively for business. Now, therefore, I can write off 15% of my mortgage or rent, 15% of my homeowner's insurance, property taxes, repairs, maintenance, landscaping, housekeeping, utilities, anything related to that home, I now get to write off out of the business. You see what we're doing? And again, we're simply taking that money out, putting it in our pocket as a business expense, tax-free to us. You're not going to see that, but it will affect your taxes. Children, how do we exploit we don't exploit children. How do we take advantage of the children's lower tax brackets? If you have children or grandchildren, in 2021, we can now pay them up to $12,600 from your business, and they don't have to pay a penny in income taxes. Well, that's a big deal. What would you pay them for? Well, you could pay them for accounting, bookkeeping, social media consultants, sometimes website developments, maybe for office cleaning, maybe office morale. A little 3-year-old could maybe walk into your office and brighten everybody's day better than you can. Maybe we pay them royalties for pictures or licensing or modeling, or maybe equipment leases. Now you'll notice that there's different colors on my slide for this. One is for earned income and one is for passive income. And this $12,600 here's the maximum we can earn in earned income. Now there's a difference, and whenever possible, we want to pay them for what they do, not necessarily just for equipment leases or for things that they passively will get, and that will increase the amount that you can pay them. Remember, compensation has to be reasonable based on the children's time, efforts, age, but I see a lot of wiggle room with this, especially when it comes to office morale and paying kids royalties. Maybe take a picture of your grandchildren, put them on your website. If it's business related, what would you pay for other children to model for you? You can get creative and stay within the IRS guidelines, but sometimes we can take a lot of money out of our business and pay our kids. What do we do with the money? Well, the very first thing I would do is I would probably set up a Roth IRA. If I've got a good income stream going to my kids, the very first thing I would do is set up a Roth IRA. Once they have earned income, and that's the requirement, earned income, you can put up to $6,000 per child into a Roth IRA. Now, you didn't pay taxes on it because it was tax-free, but according to the IRS, there's no taxes due. So we didn't pay taxes on it. Then growth inside of that Roth IRA is tax-free. So double now, I didn't pay taxes going in, although I didn't owe taxes. It's a tax-free environment, and when they go to pull money out, it's tax-free as well. So it's a triple tax-free environment. I don't know any other triple tax-free environment like a Roth IRA for children. A few years ago, we were teaching down in Orlando, and we set a little 8-year-old up on the stage in a little bar stool and said, okay, so tell us what's in your Roth IRA. And she says, well, I've got 2 residential houses, and I've got a commercial property, and we're doing tax liens, and I don't really know what tax liens are, but we're doing them, and we do a hard money loan, and her mom says, and you've got a startup business. No, Mom, I have 2 startup businesses. This little savvy 8-year-old girl is savvy because her mom is a real estate investor that's investing this loan. So she's putting in $6,000 a year. She's finding a way to pay her child for something. She's putting $6,000 in and then investing it. You imagine how that can grow in a triple tax-free environment. Now, could the child, once they're 18, use it for education? Yes. Could they use it as a first-time home buyer? Yes. Could they use it for emergency medical? Yes. And all of a sudden, otherwise it's a retirement, but I've run into children that have over $1 million in their Roth IRA, and they're still under 18 years old. If you're not utilizing this for your kids and grandkids as a business expense, you might be leaving money on the table. It's a great strategy that millionaires use often. Now, if I'm paying, let's say I'm paying a child $10,000, I'm being conservative. The first $6,000 goes into the Roth IRA, and then what about the other $4,000 that we're going to pay them? Does a minor child control their own money? So no, we're going to put it into a savings account that, frankly, Mom is going to control in most cases. And when it comes to birthday presents, let me be clear, birthday presents are not tax deductible. But if the money went in tax-free and we're using the child's account to pay for their own birthday presents, soccer lessons and piano lessons, and the kids tend to practice the piano more when it came out of their account. And they tend to pick up their school clothes more when it came out of their account. And when you're sitting down with the child and say, here's what this costs. You want to go to cheerleading school? Here's what this is going to cost you. And all of a sudden, we're teaching our kids financial responsibility, and we're taking advantage of the tax code. So, ninja strategies that are used by so many wealthy Americans, but you don't have to be wealthy to do it, but you do have to have a business. All right, see, some of you at this point are going, gosh, I really have a stupid accountant. No, you don't have a stupid accountant. What you're doing is you're giving your accountant maybe the wrong information. Ladies, if you have a purse, is it tax deductible? No, purses are not tax deductible. Of course they're not. However, if it were a computer bag and you slipped your laptop inside of it and it was purchased for the purpose of, maybe it's a cell phone case, maybe it's a tablet case, maybe it's I don't know, whatever it is, computer bags are tax deductible out of your business. Purses are never tax deductible. And what was the purpose that you bought this bag for? It's either tax deductible or not. See, the information you're giving to your accountant will tell him what little box to put that information into. And maybe you're giving him or her wrong information. Is this a vacation or is this a business trip? Is this a large screen monitor to watch the Super Bowl? Or is it a large screen TV or a large monitor for your computer? One is tax deductible, one is not. Is this a guard dog or a puppy? One is tax deductible, one is not. Meals. What was the purpose for this meal? Was it to talk business? Now, according to the IRS rules in 20 and 21, or 21 and 22, 100% of meals are tax deductible if you go into a restaurant. That's a big deal. But you have to view this. What was the purpose that I was going to this restaurant for? Was it to talk business? Then, and if that's reasonable for your business, then we deduct it. But you have to be giving your accountant the right information. Again, mileage logs. Why am I going on this trip? Why am I getting in the vehicle? we have to be giving the accountants the right information. Is clothing tax deductible? Well, generally, no, not to us personally. It's not a deduction. However, could it be an advertising expense if it had your logo on it? Could it be, oh, darn. Could it be replacement cost, killed in the line of duty while I'm teaching a seminar? I have ruined more business suits and more shirts and ties at business lunches, partly because I'm a pig, but if it happens to get ruined while you're on business, now it's a replacement cost. Dry cleaning when you're in travel status can be tax deductible. And yes, I got myself really wet, and sorry. And anyway, sorry. Anyway, retirement plans. A lot of you are not understanding the power of compounding interest in tax-free environments. And we know that, I mean, everybody knows that you can put in $6,000 in your IRA once you turn 50, then I can put in $7,000. And we do that year after year after year, it's not going to create much of a retirement account. But simple plans and SEP plans and 401ks and being able to put in $58,000 a year and then self-direct it and invest it, oh baby, that can add up very, very fast. And all of those, the IRAs, the simples, the SEPs, the 401ks, are what are called defined contribution plans, because we're defining the contribution that you're allowed to make. Then there's another thing that's called a defined benefit plan. And they look at it backwards and they say, you know what, you're 55 years old, you haven't saved enough for retirement. Therefore, to keep up your standard of living up to here, we're going to allow you to put in up to $30,000 per year to be able to make up those provisions to get you where you need to go. Those are called defined benefit plans, and there's no big flashy freeway sign saying, come take this plan. But it's right there in the IRS code. There's no secret about it. But there are so few people in America that are really good at this. We're really good at this. Anyway, okay, so there's benefit plans, employee benefit plans, group life insurance programs. You only need 2 people to have a group life insurance plan. And there's cafeteria plans and adoption assistance and educational assistance plans. They're right in the IRS code. And if you've noticed, I've put down on each one of my slides the IRS publication where I'm getting the information from. Again, we're not talking scary gray area of the law things. Just follow the rules on the road. Now, I don't have a lot more time to talk taxes, but what I am going to do is invite you to attend a 3-day asset protection summit where we're going to spend a lot of time. In fact, I think every speaker is going to be talking about whatever they do, they're always going to tie it into taxes because taxes tie into everything we do. We're bringing some of the very best of the best of the best to teach a 3-day asset protection summit. And I'll tell you a little bit about that just a little bit later. But let's get on to tornado number 2. Tornado number 2, probate and estate taxes. There's a lot of confusion about that, and a lot of people go, well, now that the estate tax, the federal estate tax, is up to, it's up to $11.8 million, 11.5, I don't know, somewhere. It's okay. Depends on the year a little bit, but it's 11 point something million, and it's indexed for inflation. And so because the federal tax law has increased, sometimes we go, well, I don't have to worry about it because my estate is under that. Or if you're married, that doubles, so it's over $22 million before you have to worry about federal. What a lot of people don't understand is that there can also be an estate tax. We call it a death tax often, or an inheritance tax. And there are several states that have adopted what they call a pickup tax. If the federal government's not going to charge you estate taxes, then we will. And so we have to be a little careful of that. And then probate probate is if you don't have a better plan for your estate. If you pass away and there's not clear title to an asset, it might have to go through probate to establish if you die and you've got a home and it's in your name and there's no successor, or there's lots of beneficiaries, but you didn't establish, I want this house to go to this person or this group of people, it's going to go through probate. And there might be a fight. And a lot of you go, well, I have a will. What we don't understand about wills and what we don't teach well in America is a will is directions to the probate court is what to do with your estate. Therefore, those assets that the will is directing will go through probate. And now probate makes it, you've got the time of probate, which can last for years and years and years. It can be expensive. Generally 5 to 10% off the top of that asset that are going through probate. And then most everything you have then becomes a matter of public record. And anybody can look and see what you had and what you received out of probate. Those are scary things. Let me tell you about my wife's family's little estate. This is, if you don't know, this is Mohonk Mountain Resort. My wife is one of the very few heirs of the 𝗧𝗵𝗲 family. They created a beautiful, actually there were two matching hotels up in the Catskill Mountains. It's about 100 miles up from New York City. It's across the river from Poughkeepsie up by New Paltz. It's a magnificent old grand hotel. Beautiful gardens. You'll notice here there's over 80 miles of walking trails that go through the property. It is a fabulous, if you look back in the fabulous property, in the back, you'll see the Hudson River, and back behind that knoll, that High Point knoll, there is the Vanderbilt Mansion, there's the Roosevelt Mansion, everything up in Hyde Park, that's back there. We are talking huge money when we're talking this estate. It's a nice little property. And if you've ever been to Mohonk or one of these grand hotels, you understand that there's a lot of money tied up in this. It was voted the #1 spa in the world in 2000 and 2002. If you ever get a chance, oh my gosh, it's a magnificent property. They were also the founding fathers of Redlands, California. So they owned a lot of the upper land that looks over the San Bernardino Valley, San Bernardino, Loma Linda. Smiley Heights was named after them. Smiley Library, Smiley Elementary, they were again the founding fathers. They brought in citrus into Southern California. They had the largest botanical gardens west of the Mississippi. You had two presidents of the United States visit their estate. It was a very, very nice estate. Estate planning was done, and they owned a huge section of land. And you can see up in the mountains there is Big Bear and Lake Arrowhead, and they can't tell you all the things that they did, but they were very influential in the development of that valley. They died with estate planning done on the New York side, but not on the California side. There were 5 heirs to the California estate. There were 4 of them got along really well. One of them didn't. He was kind of the adopted son, and he fought over a little bit of everything, and he wanted trustee fees, and he wanted this, and he wanted that. And for 19 years, they fought over this estate. In the end, each one of the 5 heirs received just a few $1,000s, and the estate was gone. The kids, the grandkids, my wife is a great-granddaughter. She remembers her grandmother well, her great-grandmother well. And she has a piece of china from the estate, but the estate is gone. I hate probate. And my wife grew up in absolute poverty. Her parents were divorced. She grows up on food stamps with a couple really nice antiques somewhere in the house, but what a mess. Now let me compare that to my father, who was never a wealthy man. He was just a small businessman. We owned a little country store in the mountains of Utah. But he did it as a estate plan well before he needed it. He had a trust. Every one of the five kids, us five kids, we all received a copy of the trust 10 years before we needed it. There were two of us that stayed in Utah for a while, and so we were the co-trustees if something happened to mom and dad. When they needed nursing homes, the house was protected because it was owned by the trust. The savings account, we had sold the business, the savings accounts, the brokerage accounts, they were all protected. There was nothing, and each one of the kids received their inheritance, and there was no fighting. They were very clear. Here's exactly what we want done. And me and my siblings get together now for Christmas and birthdays and Halloween, and we get together because we like each other, not because we're fighting over the rose-colored china, because somebody killed mom, they unplugged her when the other four didn't want her to, and don't create a mess for your kids. We can create such good, clear directions. There's no reason to send our kids through probate. Probate is 100% optional. Estate taxes are 100% optional if you'll use the proper tools in a timely manner. Jackie Kennedy died with a $93 million estate. How do we know that? Did her estate go through probate and became a matter of public record? No. It's because she chose to disclose it. What she paid in probate was zero. What she paid in estate taxes was zero. We can take almost anybody's estate, and if you allow us to use the proper tools in a timely manner, those things can be avoided. So that's kind of our message. And when we talk about most everyone with wealth, we probably recommend a revocable living trust. But the key that a lot of attorneys don't tell you, and they often don't fund the trust. So you pay them to create a trust. Let's say it's a 50-page document. Here's the trust. But they don't put stuff into the trust. Therefore, the trust can only control that which it owns. It doesn't own this asset. Therefore, it can't control it. For instance, let's say you've got your home. It's in your name. And the property tax notice is coming to you. You didn't fund it. Let me take a drink real quick. As all I had to do was go down and record a quitclaim or a warranty deed with the county recorder, conveying the property from my name into the name of the trust so the trust could own it. But I didn't do that. Now, therefore, that asset will go through probate. One of the things we're going to spend a lot of time at the 3-day Asset Protection Summit is teaching you how to fund your revocable trust, how to take your bank accounts and your brokerage accounts, and how to take your rental properties. How do we take our vehicles? And sometimes we might even list the IRA. I know the IRA was created for your benefit when you pass away. There might be a contingent beneficiary, but sometimes we list the trust as a second contingent. And we put everything into this big bushel basket that collects everything. Sometimes we'll take life insurance, and we'll also tie that to the trust. In my wife's case, she's listed as the primary beneficiary, but if she's not there, the contingent beneficiary would be our revocable trust. And then in the revocable trust is where we spell out the babysitting instructions. And we go, here's the conditions of which you get things. Here are the values that me and my wife have. And if you like education, there's a little education bonus. If you'd like a loan for a business, we like entrepreneurship. So here's the conditions. Whatever you can put into writing, if you want the kids to read the Torah or the Bible, 3 times before they get any money, or you want them to have a certain grade point average before you kick in tuition, whatever you can put into writing, you can put into that trust. And therefore it collects things and distributes it out according to the values that you've determined you want. Another thing that's really important, and that is we take also the assets we take the business interest that you have. If you've got a corporation or an LLC, We want that tied down to the trust so that upon your death, your rights and interest in this corporation avoid probate. I've seen that happen over and over again where somebody owns $1 million company, but it was set up as a single member LLC or the stock was in their name. When they pass away, who inherits the stock of that business? Whether it's an LLC, a family limited partnership, a corporation, whatever it is, we always tie your business interest back down to your trust. So again, so that they avoid probate. And we're going to teach you at the 3-day summit how to do that and how to tie in everything you have and fund the trust, put stuff into the trust. Let me tell you just a little bit about the summit that we've got. And we always, at any one year, we always teach a series of either live stream summits. These are big deals for us, or we teach a live event. We like Orlando, we like Vegas, we've been to San Diego, we've been all over the country in 22 years. But we're also teaching live stream events to get to the people that in the middle of a pandemic or that don't feel comfortable traveling or can't travel. So between live stream events and live events, it gives you a chance to get to our summits. And these are just a few of the summit speakers. Oh my gosh, we've had some magnificent talent. If you would like to enroll in a 3-day summit, we have a special offer. We have charged as much as $3,000 to attend this summit. The price tag for most people is $995. We've decided to extend that this year to you as listeners. You're interested. You've been with us now. What do we got? Almost 45 minutes on this summit or on this webinar. We'd like to invite you, and we will waive your tuition if you will attend. And what you would do is you'd go to protectwealth.com/shield and simply register that. Tell us which summit you'd like to attend, and those continue to grow. We've got some coming up almost every other month, whether it's live stream or live. Register now for that summit, and there's a cute little video of here's what to expect. Don't do that right now because we wanted to get to capital gains and lawsuit protection. All right, so capital gains is our third tornado. And again, there are toll roads and there are free roads built into the tax system to avoid capital gains taxes. Let me show you the power of avoiding capital gains and the power of trading inside of tax-free environments. Let's take a dollar bill. Let me show you an example. We take a dollar bill and we double it. And this isn't funny math. Just 1 becomes 2, becomes 4, becomes 8, and we double it. And if we double it 20 times, we can have $1 million. Now, whenever I talk to investors, real estate investors, stock market investors, I always ask them, is it possible in a lifetime of buying and selling that you can double your money 20 times? And then inevitably they say, absolutely, of course you can. But you remember, this is buying and selling without paying taxes. What if we paid taxes along the way? What if we took that same dollar bill and we doubled it, but we paid 15 cents to the government? Now, right now, our long-term capital gains rates, which means I've owned the asset for a year or more. So for most people, it could be up to 20%, but let's just assume if you're a child, it could be 0, but for the most people, you're going to be paying long-term capital gains rates right now. Currently, it's standing at 15%. All right, so let's take out 15 cents. So we take the dollar bill, we double it, and we take out 15 cents. Now, in America, we do have a military to support, and we have education programs. We have welfare programs. We have a highway system that goes throughout the nation, and I'm grateful for those. And I want you to pay your proper taxes. But let me show you the power of what happens when we do. We only paid 15 cents to the government. Does anyone feel completely ripped off right now that oh my gosh, we paid too much? Probably not. But then we take that $1.85 and we double it again and we take out 15%. And every time we double it, we take out 15%. And then watch the numbers as they grow. And this isn't funny math. This is just, we double it, we take out 15%. And what happens is instead of having $1 million at the end of 20 trades, we have $220,000. You see what happens, the long-term effect is you never accumulated significant wealth because you didn't have enough money working for you. Now are you mad about paying taxes? Well, yeah, and we should be, but that's not the end of the story, because most of us live in a state that has an additional capital gains tax. For instance, if you lived in Pennsylvania, it's only 3% additional. But at the end of buying and selling, buy, sell, trade, I fix up houses, I flip them, I studied the stock market, I buy and sell. Instead of having $1 million, I've got $154,000. Yeah, that's not good. Arizona, $134,000. Oklahoma, $127,000. I don't know what the capital gains rate in your state is, but you'll notice that the trend is not going well. New York, 8% capital gains tax. You'd have 83,000. In Oregon, 73. New Jersey, this becoming dismal, and now we get to California. Maximum capital gains rate is 13.3. So the same amount of work. You're either going to have $1 million or you're going to have $49,000. The choice is yours. Now are you mad about paying capital gains taxes? Yeah. And what happens is the wealthy who understand these principles buy and sell within tax-free environments and create wealth. And those who don't wonder why they don't have any money at the end of their life, even though they worked hard, but they don't have retirement savings to last them through retirement because they didn't know how to play the game. Now, our current law right now says maximum tax rate, usually 15%, but it could go up to 20%. And what's on the docket right now and what the proposal is to now raise that and double that from 20% to 39.6. I don't know what's this is not a political statement, but know that capital gains rates right now at 15%, that is just the tip of the iceberg of what can happen if those rates go up. Would you be interested? You remember we talked about retirement plans, and I said that most of our students don't really understand the power of what we could be doing in retirement in tax-free environments. You're not putting enough. I see investors all the time that go, I don't have retirement accounts. I'm just flipping houses. I'm just working. I don't have time for that. Well, what if we flipped the same amount of work we flipped in self-directed IRAs or self-directed pension plans or self-directed 401ks? We did the same amount of work in a tax-free environment. Yes, you might have to pay taxes on that $1 million when you pull it out, but it'll never grow to be $1 million if you pay taxes along the way. Now, these retirement plans are only one of 7 of the free environments that we're going to teach when we get to the summit. We're going to teach you about retirement accounts, but also personal residence exemption, upstream planning, like-kind exchanges. We're going to spend some time teaching you the free roads that are available to avoid capital gains taxes. Again, we didn't create these laws, Congress did, but if you don't know them, you'll never be able to take advantage of them. Not everything applies to you. Family foundation may not be in your wheelhouse right now. Charitable remainder trust might be the tool that you need. But if it is, we want to utilize the tools that Congress has given us. Again, let's come back to the 3-day summit. We're going to teach this. If you would like to register for that, again, you would go to protectwealth.com/shield, and therefore there you could register for that. And if you're doing that right now, you could do that at no cost. All right, so let's talk tornado number 4. Lawsuit protection. Again, we're going to go back to this slide on defense. We've got to learn to play defense. And again, the 3-day summit is created so that this is a defensive class. It's America's longest running class. And again, when we say a lifetime to accumulate, 3 days to protect, if you're going to sign up for this class, this 3-day summit, and we encourage you to do that. There's nowhere in America that teaches these principles better than what we do at the summit. But if you do, we want you to treat this as though you were in a seminar ballroom. Take 3 days. A lifetime to accumulate, but you need to give us 3 days. Don't wander in and out and fix, and feed the dog and answer the doorbell and answer your cell phone. We need 3 days to teach you asset protection. This is not going to be a sales pitchy. We're going to cover really good content. In fact, probably the biggest critique we get is that we're trying to stuff way too much in, and we're going to teach basic principles, but there's so much to cover in 3 days. You really need to give us 3 days, and don't think that you understand it and go off half-cocked and do more damage than you're good. We want to teach you asset protection, and so give us 3 days if you're going to enroll in the 3-day summit. Let me tell you, one of our biggest, the most frequent questions we get in customer service is, okay, what's the best legal structure for a real estate investor? I'm a real estate investor. What's the best legal structure for me? And my answer will always be, it depends. But I'm not being coy, I'm not being funny. In fact, let me tell you what it depends upon. It depends on, do you want to flip or do you want to hold properties? One brings liability, one brings a whole different set of rules. Do you want to own the title or the note? One has liability to you, one is actually fairly safe, doesn't bring liability. Are you using qualified retirement funds? Are you using leverage? Are you using, or where is your property located is probably an important thing. What state are you in? Where are you're going to hold the real estate, because there's different rules for every state. Are you using syndicated funds or other people's money? And then, even with that, are you going out and asking, or is it just passively coming to you? That makes a big difference. Are you a U.S. citizen? Are you not? You see, because, in fact, you know what, let's just break one of these down. Let's take the very first one. Are you going to flip or are you going to hold the property? Here are the concerns, and a lot of you are going to your accountant or your attorney that's not trained in asset protection. You ask the question, I'm a real estate investor, what's the best legal structure? They're going to say, well, just do an LLC. Of course. We're going to ask you a whole bunch more questions than that, and because the concerns are different. If for instance, you're going to hold properties, they're rental properties, let me tell you what your concerns are. I'm worried about resident safety. Do you know that 56% of your lawsuits will come from not keeping your tenants safe on the property? I'm worried about property managers. I'm worried about maintenance. I'm worried about protecting the equity. I'm worried about due on sale clause, because if there's a mortgage on the property, you signed a little piece of paper in the mortgage, there's a little paragraph that says if you ever transfer the property out of your name, we have the right to call the loan due. We need to be able to do this and protect it without calling that loan due. I want simplification. Not everyone needs a separate LLC for every single property that you own. We've got investors that have hundreds and hundreds of properties. They don't have an LLC for everyone. How do we simplify this and not create so many tax returns that it creates a nightmare for you? You're worried about passive losses. You're worried about depreciation deduction. You know, if you use the wrong legal structure, the IRS can come back and deny your passive losses, which means I've got 10 properties. I lost money on these 2 because I had to do a lot of repairs this year, and I'd like to offset the losses against the gains. If you're using the wrong legal structure, the IRS can deny those passive losses. Oh, that would have been good to know. And your accountant maybe missed it or maybe didn't, but your well-meaning estate planning or real estate attorney kind of didn't understand the issues, and so they suggested something that didn't work. If you're flipping properties, here are your concerns. And again, I'm not being coy. I'm just saying because you have very different concerns. I'm worried about subcontractors not getting paid. I'm worried about construction liability. I'm worried about buy-sell contracts. I'm worried about capital gains. I wasn't interested in that over here because I was holding the property, but when I'm flipping properties, then I am. I'm worried about dealer status. If you're holding properties here and you're flipping properties here, the IRS can come down and label you as a real estate dealer, which means you're going to lose all of your depreciation deductions on all properties for the last 3 years or the next 3 years coming forward. I'm not going to be able to do a 1031 exchange, or I'm going to end up paying self-employment taxes on everything that I do. I can't do an installment sale, which means if I sell a property and take payments over the next 5 years, I have to pay the gains on it right now this year, even though I don't have the money. I'll tell you, getting labeled as a dealer in real estate because you've got the wrong legal structure can be the most costly move and take all the money that you took out of the flip. And the IRS wasn't there to paint the fence or to fix the latchet on the door. You did those things, but you got dinged because you didn't understand legal structures. If the concerns are different, don't you think the legal strategies that we're going to use to protect your assets would be different? And the answer is absolutely. If we're going to talk, and so that's why I said less than 1% of the nation's attorneys specialize in asset protection. This is what we do. And these are the questions that a really good asset protection attorney or advisor should be asking you. I hope you take good notes on that. There's 2 definitions I want you to understand if we're going to understand asset protection, and then we'll get into some structuring techniques. Corporate veil is a basic thing that most accountants and attorneys don't understand, but let me define it very simply for you. The purpose of a corporate veil is to protect you from the business. Let's say, for instance, something happens in the business. Whatever you're running, your business LLC, the business gets sued. Our goal is to build a proverbial brick wall between the business and whatever you have in your personal life. We want to be able to protect your home and your bank accounts and your brokerage accounts, and we want to protect you from what happened in the business. Again, the goal here is to attract all the liability and then protect the corporate officers and directors. That's called a corporate veil. Now, you do that by maintaining the entity. If you're not paying your taxes on time, or if you're commingling funds, or if you didn't pay your filing fees, or there's a myriad of things. Corporations require minutes and meetings and resolutions and stock certificates. And if you're not going to play the game, you don't get the corporate veil. They pierce that and they come after you. We're going to teach you this at the summit, how to maintain a good, strong corporate veil. Now, there's 2 different types of entities that give you good corporate veil protection. Those are corporations and limited liability companies. Those are LLCs. And it doesn't really matter whether it's a single member, multi-member, member managed, but it doesn't matter what state. Well, actually it does on a corporate veil, but some states have stronger corporate veil protections than others. But as long as you're maintaining the corporate formalities of what you're required, you generally have a good, strong corporate veil. Now, there's another definition that you need to understand that's very different because the lawsuit comes from a different direction. That's called a charging order protection. And what it does is it protects the assets from you. Has there ever been a time in your life where you looked back and you went, yeah, I could have thought that one better? Let's say you get sued, or a family member gets sued, or whatever, you're accused of doing something wrong, or you do something wrong, and the lawsuit comes to you personally. What we want to do is now we want to build a proverbial brick wall between you and your business interests, your stock in your corporation, your interest in the LLCs, your interest in the whatever business you have. We want to be able to protect the home. your bank accounts, your brokerage accounts, your retirement accounts. We want to be able to protect them from you. But again, the lawsuit came from a whole different direction. Our goal is to protect the personal assets and your business interests from you. And there's two different types of legal structures that will do that. One is a multi-member LLC. And you notice I didn't say single owner LLC, single member. I said multi-member LLCs. And then there's family limited partnerships. And let me describe, let me tell you, kind of explain why multi-member LLCs, not single member LLCs. Charging order protection was created with limited partnerships. Limited partnerships have been around since 1916. They're pretty strong in most states. They've been up and down the state court, Supreme Court, district court, tax court. And attorneys understand that, let's say 5 partners get together, they all put in their $1 million. And if one of them, let's say partner number 2, gets sued, he does something wrong, or he's accused of doing something wrong, maybe he owes taxes, but there's a lien against him, he's going to lose this lawsuit, there's a judgment against him. Would it be fair if, let's say, the judgment creditor was allowed to come in and take all the $5 million out? Well, no, because there's 4 other partners that would get hurt. What if I can't take the assets, but I get to take all the income? I can't take the rental properties, but I get to take the rents. I can't take the stocks, but I get all the dividends. No, because again, that would hurt 4 other people. So what if I foreclose on his interest? And I become their substitute partner because I took his interest away. And a lot of states will allow for a foreclosure of a partner's interest. But let's assume you're in a really good state that doesn't allow for that. And I can't foreclose on his interest. See, the other partners didn't want me, they wanted him. They wanted this partner instead of me. So some states, again, there's a few states that won't allow for a foreclosure. We like to know what those states are. But the rule is, I can't take the assets, I can't take the income. I can't, or it's going to be a little while, 2 or 3 years before I can foreclose on his interest. So what if my hand is on top of his hand and I get to take the income that would have been distributed to him? That's sort of the rule, is that doesn't affect the other 4 partners. As all I'm going to do is I'm going to take whatever distributions he would get. That's a charging order. So I'm placing a lien against his interest in the partnership. That's called a charging order. Now we come to a single member LLC. And we look at, in 2003 was the very first time that I believe that it was challenged in America. Mr. Albright in Denver bankruptcy court is standing in front of the judge. He's got $2 million set aside, and he's saying, neener, you can't touch that because that's in a separate single member LLC. And judge, the only thing you can do is put a charging order against that, and if I distribute anything, then the bankruptcy, the court can have that. And the judge in the case looks at him and goes, Mr. Albright, there's no innocent parties here. Charging order does not apply to you because I don't care you used a single member LLC or not. I don't care what the statutes say. There's no innocent parties, and the whole theory of charging order was set up to protect innocent parties. And all of that, then there's some really other significant cases all the way down to the Olmstead case in Florida. Mr. Olmstead had he swindled a lot of people, but he had $10 million sitting in a single member LLC. And again, the judge looks at him and goes, Mr. Olmstead, there is no charging order protection for single member LLCs. As a result of that case, and maybe the precedent cases before that, the state of Wyoming met, they're within just weeks, and they said, you know what, single member LLCs are good in our state, we'll take your filing fees. We'll come here and we'll give you charging order protection for single member LLCs. Nevada, Delaware, South Dakota, and Alaska have now followed. And the other states have either been mute or been very clear that we will not give charging order protection for single member LLCs. And yet we still see over and over and over again accountants and well-meaning estate planning or well-meaning attorneys of some kind telling their clients, just put all your rental properties in single-member LLCs. You're the only owner, and therefore it will be protected. It will be protected from if something happens inside. But what happens if you get sued? I can come take all those single-member LLCs away from you. It will give single-member LLCs can give you corporate veil protection, but not charging order protection. It's important that you understand the difference between those two. See, the strength of your LLC will come from the number of members you have. We talked about that. The charging order protection in your state, which some states are much, much stronger than others, don't allow for foreclosures, do offer charging order protection for single-member LLCs. It will be depending upon the LLC operating agreement that you have. Was this created by, the fill in the blank form, or was this customized by a really good asset protection attorney that looks across the board at every LLC that's ever been broken and creates clauses so that even under duress, even in the middle of a lawsuit, you still maintain control of that LLC. And it also depends, number 4, on proper maintenance. There was a Cornell University study done a few years ago, and they found that corporate veil protection for small businesses could be pierced 67% of the time because of lack of formalities that small business owners have. That's astonishing, especially if you're running a small business thinking that you've got protection and you have no idea. One of the things we're going to do at the summit is spend a lot of time on how to maintain your legal entities, minutes and meetings and LLC operating agreements and stock ledgers, and what do you need to do in your case, tax returns, estimated payments, and adequate capitalization. We're going to spend time talking about how to maintain these legal entities that you have. All right, so enough of that. Let's talk in some basic structures and how we would set things up. Again, family limited partnerships have been around since 1916, so over 100 years. And so they're kind of the premier place we like to use in some states, not all states, but some states, for protecting safe assets. Safe being defined as things that don't cause injury, don't cause liability. So stocks, bonds, mutual funds, and savings accounts, cash, gold, silver, paintings, collectibles, things like that of value, wedding rings, jewelry, things that aren't going to cause lawsuits. Those, if they're sufficient, we might put those, let's say, in a limited partnership owned by family members, known lovingly as a family limited partnership. We might form that in a state that offers really good charging order protection, like Wyoming, Alaska, Nevada, Delaware, South Dakota, those the states that have a really good charging order protection. We might, if there's sufficient tax reasons, remember, if we can save you money on taxes, we want a business. And even if that business, the only other business purpose is to manage investments. Okay, so we create that a business, and that's generally a corporation or an LLC taxed as a corporation. Whether it's a CRS, we can define that more at the summit. That's a whole nother question. But generally, it's a management company that manages your investments, it manages your businesses, and then we create a revocable living trust. Then here's the critical thing, is instead of titling the stocks of your corporation or your interest in the LLC in your name, we title those in the name of the revocable trust. Or there might be a clause in your operating agreement that says, upon John's death, all of his rights and interests come down to a specific person, or it comes to the trust. Somewhere we tie this in so that that interest avoids probate. We take your interest in the limited partnership and we tie that somehow to the trust. We're going to spend a lot of time at the summit talking about how these ties are created and how we take those interests. You've got existing businesses. You're thinking about creating new businesses. We always want to tie those to a succession plan. If there's real estate, we might add real estate in separate LLCs, and each property or small group of properties we might put in a separate LLC to protect them from each other. We never want to mix safe assets with unsafe assets. Let's say you've got $1 million family limited partnership and we add a piece of real estate. What have you done? You've added risk to that otherwise safe bubble. And again, always tying everything that we do down to the revocable trust. Now, the problem with this strategy that we have right now is the number of tax returns. You always are going to have your personal 1040, but then the corporation will have one. Multi-member LLCs and limited partnerships will have one. You've got 5 different tax returns here. The trust doesn't, because it's really kind of non-existent. It's a disregarded entity. But your personal, the corporation, and the 3 limited partnerships or LLCs, each of one of those 5 tax returns. What if we can simplify that for you and give you less to do? And what we do now is we use single member LLCs. Wait a minute, Don, you said single member LLCs are bad. No, single member LLCs are bad when you're the owner in 45 states. If you get sued, I can take it away, but we're not going to have the single member LLCs. We're not going to have you own them. What we'll do is we title the properties or the groups of properties in a single member LLC, and in the case right here, single member LLC number 1. This might be a Texas property. I would put that single member LLC in Texas so I have standing in Texas courts, so that I pay appropriate taxes, I can evict tenants, I can enforce contracts, I can defend myself in court. But who owns the single member LLC? That might be, let's say, a Wyoming or Nevada holding company. Ooh, so single member LLCs are good, remember, at corporate veil protection. They contain risk really well, but we don't want you to be the owner because I can take those away. So now we put a hub entity in the middle. This is a holding company. Single member LLCs don't file tax returns in most cases. They're disregarded by the IRS. So what I can do is I can go around with 100 of these little single member LLCs and still only have 3 tax returns. One for me personally, one for the management company, one for the hub entity. You see what we're doing, and everything ties into the trust. Here's the beautiful thing about what we're teaching. We're taking all of the tax advantages that we told you about, and so many more, that you could write off as a business. We run that through your business. It manages everything that you do. The single member LLCs separate properties from each other or groups of properties. Maybe this isn't a property. Maybe this is intellectual property. Maybe this is a database. Maybe this is furnishings and equipment. Maybe it's a lot of different things, but it's separating assets that could get in trouble from assets that are safe. This hub in the middle doesn't own any unsafe assets. It only owns maybe a bank account, some safe assets, and interest in other LLCs that each have corporate veil protection. If you personally get sued, they're going to have to come fight you in Nevada or Wyoming that has really strong charging order protection. Alaska, South Dakota, wherever, but a stronger state than most of us live in. And everything you own eventually comes down into this big bushel basket that collects everything and distributes it out now when you're done. This is the general goal. This is what we teach. We teach it better than anyone else. I promised you at the beginning of this webinar, hopefully you stayed with us. I promised I'd be able to teach things that you didn't really understand, that's not taught in high schools, that's not taught in colleges. I hope this has been very, very helpful for you. Now, what we didn't do, there's so much we didn't have a chance to cover. We didn't talk about sophisticated LLCs, about sophisticated limited partnerships agreements. the things that you could have, the creativity you could put into your trust. We really only had half an hour or so to talk about income tax savings, preferred legal structures, the best states to incorporate, probate, estate taxes. There's so much we didn't cover, sources of lawsuits, tax-free planning. We strongly encourage you to attend our 3-day summit. We've made it as easy as we can. We're going to bring the best instructors in the nation. The former senior trial attorney from the IRS, 𝗧𝗵𝗲 𝗖𝗶𝘁𝘆, a former senior trial attorney, he's a prolific writer, and he's been teaching asset protection for us for 21 years now. Wonderful. He's turned around and sued the IRS over 2,000 times and doesn't lose a case. We're bringing Bill Danko, Dr. William Danko, a co-author of The Millionaire Next Door, and now Richer Than a Millionaire. I don't know anyone in the world that's a better expert on how to create millionaires and the lifestyle of what they're looking for. Clint Coons from the Anderson Law Group, brilliant real estate investor and asset protection strategists. We're bringing Mike and Stacy and some of the best stock market traders. We're bringing the best of the best of the best to you that we can possibly bring. Some niche real estate investors like Gene Guarino and Robert Sheeman and Aaron Adams, and we're bringing everybody to the table that we can bring to the table to teach with clarity the 3 days, but you have to give us 3 days. If you're interested in attending this class, we would love to have you come. You would simply go to protectwealth.com/shield. Go down and register now. You do have to give us your name, your email, a phone number so that we can get in touch with you. It's as simple as that. And then, seriously, take 3 days out of your life. I know it might be a weekday, it might be a weekend, it might be, I don't know when your class is going to be, but I guarantee it'll be worth taking time off. This will be a life-changing event. Some of you that are professionals, most always you'll be able to get continuing education credit for it. It's that good. We're bringing in that much firepower. So again, go to protectwealth.com. You can do that now, /shield. There's so much information that we publish on our YouTube channels, on our regular websites. But our premier event, by far, is Protect Wealth as our 3-day asset protection summit. Do not sign up for that if you're going to kind of linger and kind of come in and out and just kind of go answer the mail and go get a snack. But if you're serious about learning asset protection, we would love to have you at this event. And again, when you go to that, it'll give you all the dates that you need. ProtectWealth.com. I hope to see you at a 3-day summit, and I hope you make this year the year that you take asset protection very, very seriously. We can help you with that. Sign up for the class. Thank you for being here. We appreciate your time.